Today, the sheep and the goats. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today, I wanted to discuss the latest developments with regard to mortgage pricing and also mortgage refinancing. I have quite a number of people who are sending me emails and other communications about their own situations. And over the last couple of weeks, I've noticed an increase in the number of people who are telling me that they're having difficulty with their interest-only loans. Specifically, they tell me that one or two of the major banks have now started to put pressure on them with regard to the refinancing of those loans, and that some of them are now being encouraged to leave and to take their mortgages elsewhere. Now, this isn't totally surprising because my estimation is that there is about $120 billion of interest-only loans due for resetting each year for the next 3 or 4 years. And around half of those loans will be refinanced and reset on the same sort of basis without any difficulty. An additional 25% will probably be switched from interest only to principal and interest. And that means that the average repayment will go up perhaps 30 or 40% a month. And for many people, that will be quite difficult. But there is another quarter of households who potentially will have significant difficulty in refinancing that interest-only loan because they no longer fit within the current lending standards, which are now tighter than they were. And we've been tracking that, of course, over recent weeks. So the question is, are these people who are now receiving these letters in that category of borrowers who will not fit the current standards? And the short answer is yes. It appears to me that if you are in this latter category, you are being encouraged to switch, to move somewhere else. And the notice period is as short as a month in some cases. Now, these letters aren't standard. It seems to me that the different banks are writing to different borrowers in different ways. But nevertheless, the theme is somewhat similar. And the bottom line is this: if you are a borrower with a low loan-to-value ratio, a good income coming in, and therefore a low risk, the chances are that you will be able to reset your loan and refinance it, and you may even get a better rate. But if you're one of the others, where potentially you have a higher loan-to-value ratio or a higher debt-to-income ratio, or are now falling outside the current tighter lending standards, then you're going to find it very difficult to be able to refinance the loan. And so we are seeing the separation of the sheep and the goats, a separation of those who are low risk and those who are perceived higher risk. But of course, here's the thing. Those loans which now fall outside current lending standards were made at a time when the lending standards were significantly less focused. And we know that many people got loans they should now probably never have got. And so it's an interesting challenge for the lenders to try and figure out what to do with these difficult customers. And so some have taken the initiative to begin to persuade them to move. Now, the question, of course, is where do they move to? So it's possible that some of these higher risk borrowers could refinance with the non-bank sector, where there seems to be a little less focus on lending standards, although the interest rate may be higher. And we're seeing significant growth in that particular sector. But others will have no choice but to consider selling their property. So this is now really the rubber hitting the road with regard to the changes which we've seen in recent months. And my suspicion is that we're going to see and hear more about these borrowers who are now outside standard terms and conditions. But there could be another reason here too, and that is that down the track it is likely that we will see class actions. And those borrowers who are now outside standard conditions may have a case to bring in terms of the loan was not suitable. But if they have then subsequently moved to another lender and repaid that existing loan, the risk goes away. So it seems to me it's quite possible that below the waterline, one of the reasons why this is happening is that the banks are trying to get on the front foot with regard to the upcoming class actions and the potential consequences downstream. Now, I could be wrong on that, but there seems to have been a change in the weather in the last couple of weeks. I'll be watching this in the months ahead, and I'll be very interested to see whether, in fact, more borrowers are now being persuaded to move. The sheep and the goats. I wonder which you are. And if you've had that experience, leave a comment. I'd like to track what's going on. If you like what you've seen here today, please like the post and add a comment or question. I read them all. And if you haven't yet subscribed, please do so to receive alerts. And if you have already subscribed, many thanks. I appreciate your support and participation. I'm Martin North, the Principal Analyst of Digital Finance Analytics. Many thanks for watching, and I'll talk to you again next time.